There is an old rule in economics that governments rarely tax wealth. Wealth is quiet, wealth is patient, and wealth is very good at hiding. What governments tax is movement. And so the toll booth is never built in the middle of nowhere. It is built exactly where the traffic has to pass. In 2026, the toll booth moved closer to your front door. If you own shares, if you run a limited company, if you have spent years building something that finally pays you back in dividends, the rules of the game changed on the 6th of April, and they did not change in your favor. This is the harvest tax. You planted it, you watered it, you carried the risk of the drought, and now, on the way back from the field, there is another gate on the road. Let me show you exactly what happened and exactly what to do about it. From the 6th of April, 2026, the ordinary rate of dividend tax rose from 8.75% to 10.75%. The upper rate, the one most company directors and most serious private investors actually pay, rose from 33.75% to 35.75%. The additional rate for income above £125,140 stayed where it was, at 39.35%, 2 percentage points. It sounds small. Chancellors have always known that 2 percentage points sound small. But hold that number next to the second half of the story, which is the allowance. The tax-free dividend allowance is now £500. When it was introduced in 2016, it was £5,000. It fell to £2,000, then £1,000, now £500, and it is frozen there. So the rate went up and the shelter went down, at the same time, in the same decade. That is not an accident of drafting, that is a design. The official reasoning is stated openly, to close the gap between tax paid on work and tax paid on income from assets. Which is a polite way of saying that the government has decided that being an owner should no longer be meaningfully better than being an employee. Call it what it is. This is a success tax. It does not touch you until you have built something that pays you. Now let us run the actual arithmetic, because feelings are cheap and numbers are not. Take a higher rate taxpayer receiving £10,000 in dividends, nothing exotic, a modest portfolio, or a small company paying its owner a normal year's profit. In 2026, £500 is free. The remaining £9,500 is taxed at 35.75%. Your bill is £3,396.25. 3 years ago, that same £10,000 carried a £1,000 allowance and a 33.75% rate. Your bill was £3,037.50. The difference is £358.75, siphoned off, quietly, with no letter, no vote of yours, no change in what you actually did. Now widen the lens. In the era of the £5,000 allowance, that same £10,000 cost you £1,625 in tax. Today it costs you more than double that. The orchard did not shrink. The trees did not stop producing. The leak is on the road home. And this is the part that most people misunderstand. You did not build a public road. You built a private one. You put down the gravel. You paid for the drainage. You worked the weekends when nobody was paying you at all. And if the whole thing had collapsed, no one would have compensated you for the loss. That is what risk means. The toll booth was added afterwards. And every few years, quietly, the toll goes up, while the road stays exactly as private as it was on the day you built it. The senior partner in your business is not the person who signed the lease with you. It is HMRC. They contributed no capital. They gave no personal guarantee. They cannot be sued if the company fails. And yet they take a fixed, guaranteed share of every pound of produce that crosses the bridge. That is the strange feeling that hits you at the start of a financial quarter, when the accountant sends the numbers through on any random morning. You are not the owner of your success. You are the minority partner in it. Which brings us to the trap that catches directors specifically, the collapse of the low-salary, high-dividend model. For 20 years, the answer for owner-managers was the same. Take a small salary up to the personal allowance, £12,570, and take everything else as dividends. Dividends carry no national insurance. That was the edge. That edge is now almost gone, and here is why. Dividends are paid out of profit that has already been taxed. If your company pays corporation tax at the main rate of 25%, £1 of profit becomes 75 pence of dividend. tax that at 35.75%, and a higher rate director keeps just over 48 pence. Now run the salary route instead. Salary and employer's national insurance are both deductible. After employer's national insurance at 15%, income tax at 40%, and employees' national insurance at 2%, that same pound of company money delivers just over 50 pence. Read that again. At the main rate of corporation tax, for a higher rate taxpayer, salary now beats dividends. The dividend route only stays ahead where profits sit inside the small profits rate of 19%, under £50,000. There, £1 of profit still delivers just over 52 pence as a dividend, but 3 years ago it delivered almost 54 pence. The advantage has been cut roughly in half. So the break-even point has moved. Below £50,000 of company profit, dividends still win, narrowly. In the marginal relief band, where the effective corporation tax rate runs at 26.5%, up to £250,000, the advantage disappears entirely. Above that, the old model is actively costing you money. Now, in fairness, there is another side to this bridge. Every pound collected here funds something: the National Health Service, the state pension, the roads that your private road eventually joins. Dividend and savings changes are forecast to raise over £2.3 billion a year by 2031. Someone has to pay for an ageing population, and the argument from the Treasury is straightforward. Why should a pound earned by capital be taxed more lightly than a pound earned by a nurse? That is a serious argument, and it deserves a serious answer. The counter-argument is equally serious. Thresholds are frozen until 2031. Savings and property income rates rise by 2 points in 2027. What you get is not a tax on the rich. The genuinely rich hold assets, not income. What you get is a wealth ceiling on the people in the middle who are trying to climb out of dependence on a salary. The floor is protected, the ceiling is lowered, and the gap between the two is where independence used to be built. You can decide for yourself which of those arguments you find more convincing, but you must plan for the world as it is. So, the shield. 3 moves, in order of priority. 1. The ISA fortress, £20,000 every single tax year per adult. Dividends inside that wrapper are not taxed at 10.75% or 35.75% or anything at all. They are simply invisible. HMRC never sees them, so HMRC never prices them. For a couple, that is £40,000 a year of permanently sheltered ground. If your dividend-paying holdings are sitting in a general investment account while your ISA allowance goes unused, you are volunteering for a tax you do not owe. 2. The SIP pivot. A gross personal pension contribution extends your basic rate band. That means dividends, which would have been taxed at 35.75%, can fall back to 10.75%, a 25-point swing on the same money. And for company owners, the employer pension contribution is now the single most efficient way to move money out of a company. No corporation tax, no national insurance, no dividend tax. £1 of profit becomes £1 in the pension, against 48 pence in your hand. 3. The growth shift. Move the emphasis in your taxable accounts from yield to capital appreciation. Dividends are taxed when the company decides. Capital gains are taxed when you decide. You control the timing, you can harvest against the annual exempt amount of £3,000, and you can offset losses. Yes, that allowance has been cut brutally. It was £12,300 not long ago, and yes, gains are taxed at 18 and 24%. But control of timing is worth real money, and it is the one advantage the taxpayer still holds. Here is the conclusion, and it is uncomfortable. Wealth in Britain is no longer primarily a question of earning. Earning is the easy part. You already know how to do that. Wealth is now a question of shielding, of where the money sits, not how hard you worked for it. The orchard will keep producing, the toll bridge will keep collecting, but there is ground on the far side of the river that the road does not cross. True financial independence in 2026 is not a bigger harvest. It is a portfolio that HMRC cannot prune every autumn. If you learned something from this video, make sure to like and hit subscribe. See you in the next one.